Let's talk about the most recent Bank of Canada interest rate announcement and what it actually means for Canadians in 2026. On January 28, 2026, the Bank of Canada announced that it is holding its key policy interest rate steady at 2.25%. This was widely expected, but it's still an important decision, especially for homeowners, buyers, and anyone watching mortgage rates closely. So, why did the bank decide to pause again? The short answer is balance. Inflation has cooled and is sitting close to the Bank of Canada's 2% target, which is exactly where policymakers want it. At the same time, economic growth across the country remains modest. There are ongoing pressures from global trade uncertainty, shifting economic conditions in the U.S., and cautious consumer spending here at home. In other words, the bank doesn't feel pressure to raise rates right now, but it's also not ready to cut them aggressively either. This decision reflects a wait-and-see approach, holding rates steady while monitoring how the economy responds over the next few months. Governor Tiff Macklem reinforced that message by emphasizing uncertainty. The bank is watching inflation trends, employment numbers, wage growth, and global developments very closely. Future rate decisions will be data-dependent, meaning they'll adjust only if economic conditions clearly call for it. Now, let's talk about what this means in practical terms. If you have a variable rate mortgage, this announcement brings some short-term stability. Since variable rates are directly tied to the Bank of Canada's policy rate, holding steady means your payments, or at least the interest portion, aren't changing for now. For fixed-rate mortgages, it's a bit different. Fixed rates are influenced more by bond yields and market expectations than by the policy rate itself. While this rate hold doesn't automatically lower fixed rates, it does support a more predictable environment, especially if markets believe rates will stay stable for most of the year. If you're approaching a mortgage renewal, this pause gives you a bit of breathing room. It allows you to evaluate your options without the pressure of immediate rate hikes. That said, it's still important to plan ahead. Just because rates are steady now doesn't mean they'll stay that way indefinitely. For buyers, this announcement helps with budgeting and affordability planning. Predictable borrowing costs make it easier to decide when to enter the market, especially for those who are waiting on clarity from the Bank of Canada before making a move. Looking ahead, the Bank of Canada has made it clear that nothing is locked in. If inflation resurfaces or economic growth slows more than expected, rate cuts could be back on the table later in 2026. On the flip side, unexpected economic pressures could also push rates higher. The key takeaway is that future moves will depend entirely on how the data unfolds. So, what's the bottom line? The Bank of Canada's January 2026 decision to hold its key interest rate at 2.25% shows a careful balancing act. Inflation appears to be under control, but economic uncertainty remains. For now, Canadians get a period of relative stability, but it's not the time to be complacent. Whether you're renewing a mortgage, buying your first home, or reviewing your long-term financial strategy, staying informed and proactive is essential. Talking to a mortgage professional now can help you prepare for whatever direction rates take next. Like, comment, and subscribe for more real estate tips and information.